This is the synopsis for Chapter 7, which is using consumer loans. So I'm going to start with this page. What do we mean by consumer loans, and what are the main types of consumer loans? Well, we don't mean a mortgage. A mortgage is a mortgage. So a consumer loan would be an auto loan, for example. And in fact, the most common type of consumer loan is an auto loan. If you get a loan for an automobile, you're using the auto as collateral. Therefore, the interest rates tend to be fairly low. And a lot of times the dealerships will give you, they'll have advertising campaigns or deals where they'll give you a really low interest rate. If you buy a used car, the interest rate tends to be slightly higher. But anyway, the main takeaway here is to know that auto loans consumer loans do not include mortgages, and the most common type of consumer loan is an auto loan. Okay, what are some other loans? What are some other types of consumer loans? Well, you can get loans for durable goods. Let's say you wanted to buy furniture, or you needed to buy appliances. You could get a consumer loan for those. Now, that type of consumer loan would not have any collateral. If you have a consumer loan that isn't backed by any collateral, meaning an underlying asset, the interest rate is going to be a little bit higher. Education loans are also a form of consumer loans, student loans. Now, I just want to talk briefly about student loans. They go into a lot of detail on the slides and in the chapter about student loans. You don't really need to know all those details. But the main takeaway with student loans is that's good debt. Don't worry about it if you are getting out of nickels with some student debt, or if you want to go to grad school and need to take out student loans, because it's considered good debt. Why is that? Because you're investing in yourself. Any economic study that you see or statistical study that you see has a significant positive correlation between the amount of education that you have and your lifetime earnings or your salary. Therefore, an investment in yourself by going into debt with student loans is considered good debt. It's not considered bad debt because you're going to have increased lifetime earnings as a result of more education. And with the payback, when you pay back these student loans, they're very flexible and the interest rates tend to not be too high. Okay, so that's the student loans. That's all I'm going to say about that. Personal loans, that is, now, let me back up to this one. You could possibly get a loan for durable goods that's backed by the actual asset that could be collateralized. But if you get a personal loan means definitely no collateral. Let's say that you have run up credit card debt and you want to get a personal loan at a lower interest rate than your credit cards. So you could get a personal loan and then pay off your credit card debt. Or they also would call that a consolidation loan. Now, let me talk a minute about personal loans versus consolidation loans. If you're getting a consolidation loan, let's say that you have $20,000 in credit card debt and you get a consolidation loan. You're not going to get the money yourself. They would give you a $20,000 loan, for example, specifically to pay off the credit card debt, and it would be made out to those companies. So a consolidation loan tends to have a little bit lower interest rate than a personal loan, and definitely would have a lower interest rate than your credit cards. So if you want to consolidate debt, you can get a consolidation loan. But if you just want to get a personal loan because for whatever reason, a wedding, go on vacation, then there's no collateral backing that loan. So the interest rate's going to be a little bit higher than a loan that's backed with an asset. Okay, so just make sure you know the types of consumer loans, and the auto loans are the most common, rather. All right, I'm going to skip all this about the student loans. Just read what are the different types of student loans. That's about all you need to know there. Um, okay, consumer loans are usually installment loans that are typically have a fixed rate. So they have a fixed interest rate, payments remain the same, and they're for a number of years, and then you just make the same payment over time each month. What are your sources of consumer loans? Well, if you belong to a credit union, that is the best source for consumer loans because the interest rates tend to be lower. After that, you could go to a savings and loan or a commercial bank. Avoid these finance companies. They really, they're very predatory, in my opinion. They have very high interest rates. So avoid these finance companies at all cost. At all costs. I'm talking about like payday loans and things like that. A payday loan is a loan that you get because you can't make it to the end of the month. You run out, you don't have enough money to live until you get your next paycheck. They charge, their interest rates are over 30%. It's ridiculous. So avoid those finance companies. Don't get in that situation. So if you need a consumer loan, the best way to get one is through a credit union or a bank. Friends and relatives not advisable, ruins relationships. If you have a life insurance policy, if you have a whole life insurance policy, those build up a cash value. You can get a loan from your life insurance policy. Now, if you should die, it's going to be reduced. The payout would be reduced by the amount of the loan, but that's a really easy way to get a loan, and you're just paying yourself back. So if you've had a life insurance policy for several years and it's built up a cash value, you can get a loan from that cash value. All right, what factors should you consider when comparing loans? Obviously, the interest rate, how long the loan's going to be. Are there any other costs? Always ask if there's a prepayment penalty. You want to be able to pay the loan off early if you choose to. Okay, that's just telling you to use that debt safety ratio to make sure you don't get in too much debt. Keep track of it. Single payment loans, I'm not even going to bother with those because nobody really gets those. They're not very common to get a single payment loan. Most loans are paid monthly. The APR is the interest that's charged, the annual percentage rate. When you get the loan, on the front page, they have to tell you what the interest rate is and any finance charges. If you go through a bank, you're not going to have any finance charges paid in advance. You're just going to have the interest rate. Now you can skip all this math here. That's not going to be required of you in this class. But they're just talking about simple interest versus the average percentage rate and all that. But all you really need to know is you're going to see the APR on the front page of the loan document, and that's going to tell you what the rate is. So you can skip the discount method and all this. You can skip these calculations. Now, some people will get what's called a home equity loan. Now, if let's say you buy a house, you have a mortgage, and then some years down the road, so let's say it's 5 years, let's say that you only owe $200,000 on your house and it's worth $400,000 now. Well, you can get a loan up to your total loan, the total loans or mortgages against your house cannot be more than 80% of the value. So if you only owe 200,000 and the house is worth 400,000, you can get another 160,000 more because you can get up to 80% of 400,000 is 360,000. Or I'm sorry, wait a second, I messed that up. 400,000 times 0.8 is actually 320,000. So if you had a $200,000 mortgage outstanding balance on your mortgage, and the house was worth 400,000 now, 80% of 400,000 is 320,000. 320,000 minus 200,000 is $120,000. That means that you could get a second mortgage on your house for up to 120,000. And with a second mortgage, you go through the same process as your first mortgage, and it can be however many years you choose. It can be 10, 15, 20, up to 30 years. And it's just another mortgage. It's a second mortgage. But an easier way to tap into the equity is to get what's called a HELOC, a home equity line of credit. And so I could go to a credit union, savings and loan, or a bank, and I could say, hey, I want to get a line of credit on my house, and I have up to $120,000 available. And so they would more than likely qualify me for that. And so basically it would be an account that gives me the opportunity to use up to 120,000. So that's a home equity loan. And they give you a debit card or a check or what have you, checkbook, what have you, and then I can use it or not use it. So I would have that option. So a lot of people, when they have equity in their houses, they have these HELOCs. And if you go back to the previous chapter, when we were talking about budgeting and budgeting for emergencies, well, if you have a HELOC, this is a perfect example where you don't have to have 6 months of your net income in the bank in a checking account or savings account, because you could access this home equity line of credit if needed. All right, so the typical home equity line of credit, the term varies, but it's usually 10 years. So what that means is that you can access it for 10 years. They want you to, anything that you put on there, any funds that you access would have to be paid off in 10 years. But you could always, get another HELOC if you need to after that. And the interest rates are similar to mortgage interest rates. It's usually prime plus a couple of percentage points, the prime rate plus a couple of percentage points. Okay, so let's take a look at payments and what the payment, how much would it cost to repay these loans. So let's just say, for example, you had $1,000 loan. Let's say you got $1,000 consumer loan for a vacation or for whatever, let's say it was let's say you had car trouble. You needed $1,000 loan. You can see how much your payments would be. And if you had a 12-month loan, this is what your payments would be versus a 60-month loan. But you're paying a lot more interest on a 60-month loan versus a 12-month loan. So you can just see what the differences would be there. Now, this is important to look at. I want to make an important point here. This is an amortization table. So you have this $1,000 loan at 6% interest. It's a 1-year loan. You're making monthly payments. You have 12 payments. The interest that you pay is based off of the beginning balance. And so this is wrong because, let's see, this is 5%, not 6%. But anyway, never they're saying 6%, but that's $5 off 1,000 is actually 5%. But forget about that for now. What I want to show you is how the interest payments that you make decrease as you go throughout the loan, as you make payments, and how the balance decreases. So, and more is going to principal. So anyway, what I want to show you here is your first payment, you're paying $5 in interest. Okay. Your payment was $86 and you're paying $5 in interest. Your second payment, you're paying $4.59 in interest. And if you go all the way down to your last few payments, you're only paying 85 cents and 43 cents in interest. Okay. So why is this important? Well, this is important because if you pay a loan off early, you save a lot of money in interest. Because let's just say, for example, you made double payments. Well, if you made double payments, then your next payment, you're going to be all the way down to $4.19 in interest. So especially early in a loan, it makes a lot of sense to make double payments if you can afford to, extra principal payments, or to pay the loan off early. Now, if I got this $1,000 loan, say for car repairs, and then I came into a windfall of money in months 2, 3, 4, or 5, I would probably pay it off. But if I'm at the second half of the loan, payment 6 through 12, I'm not paying very much money in interest anymore, so I probably wouldn't bother to pay it off early. It's really, it really is striking when you look at a mortgage. For example, if you have a 30-year mortgage and you pay it off in 15 years, you've cut the amount of interest that you've paid in half. If you just make one extra payment a year on a 30-year mortgage, you bring it all the way down to a 22-year mortgage on average, and you save a lot of money in interest. So keep that in mind when you get in the position of life where you have a car loan or where you have a mortgage, because making extra principal payments, paying down on the principal, especially in the early part of the loan, really pays off. And also, and again, always ask and make sure there's no prepayment penalty. I've never heard of a car company, auto loan that had a prepayment penalty. None of these banks or credit unions have prepayment penalties. The only time you might get into a problem with a prepayment penalty is if you're at a retail store, furniture store, appliance store, or one of these finance companies. Then you definitely want to avoid any loan that has a prepayment penalty. Okay, you can skip the calculations here. Okay, now this is another thing I wanted to mention. When you get a loan, they'll try to sell you, a lot of times when you get a consumer loan, the company giving you the loan will try to sell you credit life insurance. That means that if you die, the loan will be paid off. This insurance is expensive and is not a good deal. So if you're worried about if you should die prematurely and you don't, and you want the loan to be paid off, just get a term life insurance policy. It's a lot cheaper. So you could, let's say you have a $20,000 loan, consumer loan. Well, you could go get a $20,000 life insurance policy for a few dollars a month, and then you would be covered. The other issue with a credit life insurance policy, in addition to that it's expensive, is that as you pay off the loan, the benefit amount decreases. So why not just get a term insurance policy that stays the same, say it's 20,000 or 10,000, stays the same no matter how, whether you've paid this loan off or not. So always avoid credit life insurance. Okay, and this this is the last slide, so I think that's it. All right, so this is it for chapter 7. And let me look at my notes real quick to make sure that I don't want to add anything else, and I don't believe that I do. So as always, reach out to me if you have any questions. Thank you. Bye-bye.